Buying a home in California just got a little bit easier, especially if you fall within that low to moderate income bracket and you're a first-time home buyer. There's a new loan program coming out as of March 27th, 2023 through Senate Bill 197 called the Dream for All Shared Appreciation Loan, which is being authorized by the California Housing Finance Agency, also known as CalHFA, and is there to provide shared appreciation loans to help low and moderate income families achieve home ownership. These shared appreciation loans will provide assistance with down payment as well as closing costs. So what do I mean by a shared appreciation program? Well, they're going to give you a down payment to help you buy a home, which we'll talk about the specifics here in just a moment. But when you go to sell that home, not only do you have to pay that down payment that they gave you back, but you also have to pay a percentage of your equity. And if that's overly concerning for you, don't get too concerned. I'm actually going to give you some examples that goes over, how much appreciation they'll be taking so that you know exactly what you're getting into. But at the end of the day, it does sound promising. But with that said, there are some specifics that you need to be aware of when it comes to both income as well as loan limits and who can actually qualify for these programs. So this Dream for All Shared Appreciation Loan is a down payment assistance loan provided to first-time homebuyers to be used in conjunction with the Dream for All conventional first mortgage. So with that said, I want to be very, very clear. This is a conventional loan. So you're going to be underwritten based on conventional guidelines, not FHA, not VA, not USDA, which means the guidelines are going to be a little bit more strict. Typically on CalHFA loans, they have a hard cutoff with a 45% debt to income ratio, which means that it may be a little bit more difficult to qualify for this loan, which understandably so. They're giving away free money. They want to make sure whoever they're giving this money to actually has the ability to repay it and will likely repay it. So therefore the guidelines are going to be a little bit more strict. At the moment, we don't have an idea of what the rates, the fees are going to be associated with this. We don't really know, how it's going to be affected with certain credit scores versus other credit scores because there's still some unknowns out there because the program actually hasn't come out. There's still some information we're missing, but I wanted to provide as much as I could because this loan program is coming out within a couple of days. So if you're a home buyer out there planning to buy a house and you're thinking this is a program that may work for you, it's good to get as much information as you can, as soon as you can. So that's why I'm providing it right now. As we get more information on it, I'll continue to update it. So as I mentioned, the Dream for All Shared Appreciation Loan will give you up to 20% of the sales price or the appraised value. So in the example that you're buying a $500,000 home, they'll gift you up to $100,000 of that down payment in order to help you buy that home. But here's the catch, if you will. This is the shared appreciation loan terms, how it actually works. So whenever you sell that property or you transfer the loan, the homeowner agrees to repay the original loan down payment in addition to a share of the appreciation in the value of that home. So you're probably wondering, what does that look like? Well, let's dive into some actual numbers. But before we do that, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Not only does it help the YouTube algorithm push it out to more people, it helps me accomplish my goal of educating home buyers. And also feel free to subscribe to the channel to stay updated on information like this, as well as everything real estate related. Now, one other thing before we dive into that example, something I forgot to mention earlier, is that there is a loan limit restriction. The max loan amount on this program is $726,200, which actually yields an estimated purchase price of just over $907,000. Because if you bought a $907,750 house and you put 20% down, that would give you that max loan amount that I mentioned just a moment ago of $726,200. In addition to that, California has only allotted $500 million towards this program. Now, that probably sounds like a lot of money, but understand this is for the entire state of California. So the more people that buy homes using this program, the quicker that money is going to run out. And quite honestly, I expect it to go pretty fast. Now, this isn't a push to get you to buy a house sooner than later, but I think if you end up waiting, then most of the money in this fund is going to run out and you're not going to have an opportunity to use it. Now, before we dive into example number one thing I want to mention is there are income restrictions on this program. You can't make more than a certain amount of income. Now, in the guidelines, it says that you can't exceed CalHFA income limits. Now, I'm going to throw a chart here on the screen showing you what the loan limits are for CalHFA in different counties across California. And typically speaking, this is the income for the entire family, not just one person in the family, the entire family. So if there's two people that live in the household, it's going to be the combined income of both of those people cannot exceed that amount. Now, what happens in the case where you have a couple of people living in the house? You have dependents. Well, typically speaking, it's household income. So if there are children living in the house and they're dependents and they report on your tax returns as dependents, that income for those family members is going to be used in the total household income. Now, this is where it can get really tough to figure out, especially if you're trying to do this on your own. That's why I recommend speaking to a mortgage professional, someone that understands loan programs, can guide you through the process, not you at home trying to figure this out. And the reason I say this is because sometimes it can be difficult to interpret what these guidelines actually mean. And lenders, they're actually paid to understand this information. So just make sure you're working with a professional that understands it, and also understand not everyone in the state of California can do one of these loans. They have to be a CalHFA approved lender. And the majority of banks out there are not CalHFA approved. So you might call someone on the phone and say, hey, can you do this program? And they say no, because they don't have access to these lenders. So do me a favor, if you need a CalHFA approved lender in the state of California, do me a favor and check the link below. So in example number one here, we're going to talk about the program appreciation share, how it actually works. So this is an example of a moderate income borrower. This is for borrowers with incomes above 80% of the area median income. And how they're getting that is they're using the Home Ready lookup tool, which I provided a link below to go to that link to figure out, the area median income for your area, to figure out, where you fall on that spectrum, whether you're 80% of it, whether you're at the median income, maybe you're at 150% of it. But this example is for incomes above 80% of the area median income, but less than or equal to the CalHFA income limits, which in the case where I went over Orange County, that's $235,000. In fact, I went to that link to look up the area median income for where I live, and as you can see here, it's $97,900. 80% of that in this case is $78,320. So your income would have to fall between $78,320 and that $235,000 that CalHFA allows. But this is where it gets a bit confusing, because the example that they use, they're saying the borrower's income falls between 80% of the area median income and 150% of the area median income, which in the case of Orange County, where I'm located, $97,900, 150% of that puts me at $146,850. That's quite a bit less than the $235,000 that CalHFA requires. So with that said, I'm not sure if the max loan amount is the CalHFA at $235 or 150% of the area median income. So that's why it's super important to make sure you're speaking with a mortgage professional so that you can figure out what the exact limit is and see whether or not you qualify. So nevertheless, in the example that we're using here, we're going to say that you're buying a $500,000 home, that they're giving you the 20% for the down payment. So they're providing a $100,000 down payment for you, which means essentially you're financing $400,000. Now with that $400,000 that you're financing of that dream for all CalHFA first mortgage, which we don't have all the specifics on at the moment, but again, likely to have a max DTI of 45%, which is not going to count the $100,000 down payment that you're being gifted. That's a silent second lien on your property. There's no payments on it, so it shouldn't count in your DTI. But let's just say after 5 years, that $500,000 home now appreciates to $640,000. That means it's gained $140,000 in value and appreciation over that 5-year period of time. So in the case that you go to sell that property, you take 20% of the appreciation. So of $140,000, 20% of that is $28,000. You take the original down payment that they gave you, $100,000, and you give back to CalHFA $128,000, leaving you with $112,000 of that appreciation. Because you got 80% of the appreciation, you're still walking away with a good amount of change. And without this program, you likely wouldn't have been able to buy a house. So yeah, it sucks giving up 20% of your appreciation to CalHFA and giving back the original down payment, but that's just part of the program. Now, with that said, they do have a cap on the appreciation. It's 2.5 times of the original principal amount. So in the case of the example that we gave just a moment ago, the original principal amount that they gave you was $100,000. So the max appreciation that they could take out of this property would be $250,000 in addition to the original amount. So in this example, the max they could take would be $350,000. Now, let's be completely honest. I don't see a world in which that home could appreciate so much that they could actually max that cap out. So that's not likely a concern. So if I were buying a house and I was using this program, I would just assume they're going to take 20% of that appreciation. Now, what happens in the case that you own the home and in 5 years you go to sell it and there is no appreciation? Do you owe additional money? What happens in the case that the home is worth less than you purchased it for? While I don't think that is likely, it could happen, right? Anything is possible. And quite frankly, I don't know the answer to that. I don't know if you still owe them the full amount that they gave back, or if you're just responsible for a portion of it because you lost money on the deal. Those questions I can't answer at this time. But with that said, let's do one more example using a low income example, because the shared appreciation amount is a little bit different on that example, as instead of taking 20% of the appreciation, they're only taking 15%. So if we're using the exact same numbers that we used earlier, you buy a $500,000 home, they give you the $100,000 down payment, and you go to sell that property in, say, 5 years, and now it's appreciated to $640,000. Well, you owe them the original $100,000 that they gave you back. But what happens with that $140,000 of appreciation that you gained? Well, they take 15% of that. In this example, that would be $21,000, leaving you with the remainder, $119,000. So who actually is considered low income? Well, it's someone that makes less than 80% of the area median income. So again, using the example that I gave you earlier, my market, $97,900 is the area median income. 80% of that is $78,320, which means that your household income cannot exceed that amount to fall within this low income bracket. Now, quite frankly, I find that really, really low. I mean, where I'm located here in Orange County, you can't really find a home for $500,000. Yes, you can find condos, but even then they're very, very hard to come by. So at the end of the day, this is a really great program for people that qualify, but I also think it sounds a lot better on paper than it actually may be for the majority of people out there. Yes, it's going to work for some people, but for the majority of people that want to buy homes, the restrictions are still a little bit tight because of the income requirements. A lot of people out there that are going to want to buy are going to exceed these amounts. And those that make the money and want to buy properties, some of them just aren't going to be able to because of where home prices have gone. So I realize I just gave you a lot of information, but one thing I'm going to remind you of once again is to make sure you're working with a lender, someone that understands a program, someone that can guide you through that process, understands the ins and outs, as this video is more for novelty purposes than it is anything else, just to give you some basic information. So make sure you're speaking with a lender. You can find one in the link below. If you're watching this and realizing, well, this program may not work for you, but I still want to buy a house, what should I do? Well, do me a favor and check out this video here.